Hello everyone. Many of my clients have had queries about reinvestment of capital gains in property. Today's video will answer all those questions and more because I will be interviewing an expert in taxes who has over 40 years of experience. We have Mr. Cyrus Bharucha, the man who started the Bangalore branch of Kalyaniwala Mistri and who recently retired as a partner 3 years ago. He now runs CJ Bharucha and Company that specializes in tax consultants, governance and advisory services. Cyrus and I have worked together with many clients, especially where it involves capital gains reinvestment. Here's a sneak peek of what's to come.
Ancestral property purchased in the 50s, 60s, at a ridiculously low price. It doesn't make sense to index from that time. Sometimes identifying a good value also is a challenge. The maximum you can have is 2 residential houses.
Thank you for taking out your valuable time for this brief conversation.
Thank you for the generous introduction.
I just wanted to start with basics. What is capital gains and how to calculate it?
Basically, any profit or gain on a sale or transfer of a capital asset is capital gains. Capital gains is taxable in the year in which the capital asset transfer takes place. Capital gains are of two types, short-term and long-term. If a property is held for less than 2 years, short-term, and if it is more than 24 months, it is long-term. Equity shares, listed, unlisted, that would be a little too long, but this is the basic of capital gain.
So, to paraphrase you, basically, we'll be concentrating on property today. So, if a property is sold within 2 years of its purchase, it's considered as a short-term capital gain.
Short-term, and then none of the exemptions or the reinvestment and all are applicable. The gain would be taxed at the rate of 20%.
Okay. What are the ways then to avoid paying capital gains? Let's say a person has held it for a long term, that is more than 2 years.
That it should be a long term. And sale of a residential house, you could invest in another residential house, provided the maximum you can have is 2 residential houses. If you have 3 and you sell one residence and the gain cannot be invested in another residential house, and you cannot claim exemption over there.
Okay. So, is there any time extension if you do not reinvest your capital gains, and how soon should you buy the second house, and what can you do if you miss the deadline, and in the interim, where should you park your funds?
Yes, you need to invest the capital gains in a scheduled bank in a capital gains exemption account within 6 months of the date of transfer. Once you've invested there, then you identify whether you want to buy another property or you want to construct. If you want to buy, you have 2 years time to buy a ready-made residential property or 3 years to construct.
Okay. If we are buying from an NRI, what is the percentage of TDS to be deducted? And is it different is the percentage different when buying from a resident Indian? Now, I'm talking about TDS now, not capital gains.
If a person is not taxable, they could well approach the assessing officer and request for a lower deduction certificate. So they go to the assessing officer, give their projected income and say, I'm not taxable. For non-residents, it is at the maximum margin rate that is close to 30%.
Is it a slab rate or is it the same for?
It is flat, but then depending on the capital gain, your surcharge changes.
Okay.
From 10%, 15%. So, and then cess on that. So there would be a little bit of a change. If you purchase from a resident, if the property value is more than 50 lakhs, there's a 1% TDS which you need to deduct and remit to the government. The form is called 27Q.
What is the time taken to get a reduced income tax certificate, which you had mentioned?
4 to 6 weeks. Provided you have all the details that the assessing officer requires to satisfy himself that you require.
What are those details, Cyrus? What are the details an assessing officer is looking
Basically, you
at?
have to share your past year's income tax returns and your expected returns for the current year, and the calculation of the capital gains, I mean, he has to satisfy himself with all that, and then they issue a lower deduction.
Is there any cutoff date when you're calculating the capital gains tax? You'll have to find the cost of acquisition of that property. So, is there any cutoff date for old properties?
Called cost indexation, and any property bought or owned prior to 1st April 2001, you will have to get a government registered valuer to value that property, and that would be the value of the property irrespective of when the property has been purchased. Ancestral property purchased in the 50s, 60s, I mean, at a ridiculously low price, it doesn't make sense to index from that time. So the government has allowed you to value the property on 1st April 2001. From that date, you apply the indexation up to the year of sale, and then that would be the cost in the hands of the seller.
Okay.
Now, even if the property has been gifted or inherited from father, grandfather, the period of holding would be from when the property was originally held.
Means
So if a person say passes on in the year 2005, but he has inherited from his father who has acquired the property in 60s, you still have to do the valuation as of 1st April 2001, apply indexation from then, and then calculate the capital gains.
okay.
From the sale proceeds, you have to deduct any expense directly related to the transfer, brokerage or legal fees or whatever.
Cost of improvement.
And if there's cost of improvement subsequently,
Okay.
you have built another floor after 5-6 years, then that period also you could calculate the cost of indexation.
Recently, I had sent you a client, and they had a very old house which they sold, and they were having a
Yes,
big problem for the valuer to go inside the house to check it up, because by then they had given a possession, they had sold the property, and their own purchaser was acting up, and they had to do a lot of convincing to let the valuator in to assess the property.
They probably thought some government official is entering the house. Sometimes identifying a good value also is a challenge.
Yeah, and that is a very good value addition, because the client I referred to you earlier, they had gone to 2-3 other chartered accountants who just gave them some valuator's number, and whom they had to coordinate with him directly. So when they came to you, they were super happy because you had everything in house with you. And one last question I have. Some of my clients, they're NRIs, and before they're selling the property, they don't want the purchaser to deduct this 20 odd percent as tax. So what they're doing, they're gifting it to their mother or something like that. And then they're saying the mother can sell the property. What do you think of this? Is it foolproof? Because the mother will sell it immediately after becoming a donee, after she gets the property.
There's no issue. Any gift to a close relative is exempt from tax. So they could gift the property to their mother, but the treatment would be the same. You still have to calculate valuation as of 1/4/2001 if it is an old property. Do the indexation, and if there's a substantial amount of capital gains, then I don't think they will enjoy any lower deduction. Then it is best to discharge the tax, and leaving the money in India, some people do not agree to, so they can remit the money back.
Okay. And is there anything else you want to, any interesting thing or any other relevant point you want to add to this, which I may not have directly asked you?
My only advice to assessees would be not to come to a professional post the transaction, because then certain surprises get thrown up.
Yes. And I think most of the clients have expressed to me that they wanted end-to-end services, because they don't want to come to a lawyer and then run around to a chartered accountant. And many chartered accountants their super specialty is not property tax, not property
Yes.
capital gains. So there is a problem finding the correct chartered accountant also. I wanted to make this video to tell the client all the pitfalls that may arise and how to go about smoothly transacting on the same. So thanks a lot, Cyrus, for taking out your
Welcome.
valuable time.
Thank you. Thank you
Thank
very
you.
much.
Bye.